Hello and welcome to my channel, where I share with you the latest news and insights on Bitcoin and other cryptocurrencies. In today's video we dive into the dynamic world of cryptocurrency trading. In this exciting video, we uncover 10 bearish trading indicators that every crypto trader should know. We will decode the signals that can help you navigate the market with confidence and make informed trading decisions. Before we jump into the indicators, let's understand why identifying bearish signals is crucial for crypto traders. In an ever-changing market, recognizing signs of a potential downturn allows traders to protect their investments and potentially profit from short-selling opportunities. Bearish crypto trading indicators are tools that help traders identify and anticipate potential downtrends or selling opportunities in the crypto market. These indicators can provide valuable information and signals that can enhance your trading strategy and performance. However, bearish indicators are not infallible, and they should not be used in isolation, but rather in combination with other indicators and factors. In this video, I will show you how to use 10 bearish crypto trading indicators, and how to interpret their signals and patterns. Let's get started. Number 1 on our list is moving averages, MOS. They are one of the most basic and widely used crypto trading indicators. They help smooth out the price data over a specified period of time, making it easier to identify the general trend and direction of the market. There are two types of MOS: simple moving average, SMA, and exponential moving average, EMA. SMA is calculated by taking the average of the closing prices over a certain number of periods, while EMA gives more weight to the recent prices, making it more responsive to the latest price changes. In a bearish market, when the short-term MA crosses below the long-term MA, this usually signals a potential downtrend or a bearish trend reversal. This is known as a death cross, and it indicates that the sellers are gaining more control and momentum over the market. Number 2 on our list is Relative Strength Index, RSI, which is a momentum oscillator that measures the speed and magnitude of price movements. It can help traders identify overbought or oversold conditions in the market, which may indicate potential reversals or trend changes. RSI ranges from 0 to 100, and it is usually calculated over a 14-day period. An RSI value above 70 indicates that the market is overbought, meaning that the price has risen too much and too fast, and it may be due for a correction or a pullback. An RSI value below 30 indicates that the market is oversold, meaning that the price has fallen too much and too fast, and it may be due for a bounce or a recovery. In a bearish market, when the RSI crosses below 70, this may signal a potential selling opportunity or a bearish trend continuation. This indicates that the market is losing its bullish momentum and strength, and that the sellers are taking over. Following, we have Bollinger Bands, which are a set of lines that are plotted around the price chart, with one line representing the moving average, and the other two lines representing the standard deviations above and below the moving average. These bands help traders identify the volatility and the range of the market, as well as potential breakouts and reversals. The width of the bands indicates the level of volatility, with wider bands meaning higher volatility, and narrower bands meaning lower volatility. The position of the price relative to the bands indicates the trend and the momentum of the market, with the price above the upper band meaning an uptrend, and the price below the lower band meaning a downtrend. In a bearish market, when the price breaks below the lower band, this may signal a potential bearish breakout or a bearish trend acceleration. This indicates that the market is experiencing high volatility and downward pressure, and that the sellers are dominating the market. Number 4 on our list is MACD, or Moving Average Convergence Divergence, is a trend-following indicator that shows the relationship between two moving averages of the price. It consists of two lines: the MACD line, which is the difference between the 12-day EMA and the 26-day EMA, and the signal line, which is the 9-day EMA of the MACD line. The MACD also has a histogram, which is the difference between the MACD line and the signal line, and it shows the momentum and the direction of the market. In a bearish market, when the MACD line crosses below the signal line, this may signal a potential downtrend or a bearish trend reversal. This is known as a bearish crossover, and it indicates that the market is losing its bullish momentum and strength, and that the sellers are gaining more control and influence over the market. Number 5 on our list is stochastic, which is another momentum oscillator that measures the position of the price relative to its high-low range over a certain period of time. It can help traders identify overbought or oversold conditions in the market, which may indicate potential reversals or trend changes. Stochastic ranges from 0 to 100, and it consists of two lines. The blue line, which is the current value of the stochastic, and the red line, which is the 3-day SMA of the blue line. An stochastic value above 80 indicates that the market is overbought, meaning that the price is near the upper end of its range, and it may be due for a correction or a pullback. An stochastic value below 20 indicates that the market is oversold, meaning that the price is near the lower end of its range, and it may be due for a bounce or a recovery. In a bearish market, when the blue line crosses below the red line, this may signal a potential selling opportunity or a bearish trend continuation. This is known as a bearish crossover, and it indicates that the market is losing its bullish momentum and strength, and that the sellers are taking over. Number 6 on our list, Fibonacci retracement, which is a technical analysis tool that uses the Fibonacci sequence, a series of numbers where each number is the sum of the previous two numbers, to identify potential support and resistance levels in the market. These levels are based on the ratios of the Fibonacci numbers, such as 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Fibonacci retracement can help traders identify potential reversal points or entry and exit points in the market, by measuring the percentage of the price movement from a high point to a low point, or vice versa. In a bearish market, when the price retraces from a low point to a high point, and then reverses at one of the Fibonacci levels, this may signal a potential selling opportunity or a bearish trend continuation. This indicates that the market is facing resistance at that level, and that the sellers are pushing the price back down. Number 7 on our list, Ichimoku Cloud, or Ichimoku Kinko Hyo, is a comprehensive indicator that shows the trend, momentum, and support and resistance levels of the market. It consists of 5 lines: the Tenkan Sen, which is the 9-period midpoint of the high-low range, the Kijun Sen, which is the 26-period midpoint of the high-low range, the Senkou Span A, which is the average of the Tenkan Sen and the Kijun Sen, shifted 26 periods ahead, the Senkou Span B, which is the 52-period midpoint of the high-low range, shifted 26 periods ahead, and the Chikou Span, which is the current price, shifted 26 periods behind. The area between the Senkou Span A and the Senkou Span B is called the cloud, or the Kumo, and it shows the support and resistance levels of the market. In a bearish market, when the price is below the cloud, this indicates a downtrend or a bearish bias. When the price crosses below the cloud, this signals a potential bearish breakout or a bearish trend reversal. When the cloud changes from green to red, this confirms a bearish trend change. Number 8 on our list is on balance volume, OBV, which is a technical trading momentum indicator that uses volume flow to predict changes in stock price. It was first developed by Joseph Granville in his 1963 book, Granville's New Key to Stock Market Profits. The OBV metric is based on a cumulative total volume, which is assigned a positive or negative value depending on whether the closing price is higher or lower than the previous day's closing price. OBV is used to predict the probable direction of near-term price changes. It shows crowd sentiment that can predict a bullish or bearish outcome. The theory behind OBV is based on the distinction between smart money, namely institutional investors, and less sophisticated retail investors. As mutual funds and pension funds begin to buy into an issue that retail investors are selling, volume may increase even as the price remains relatively level. OBV is generally used to confirm price moves. The idea is that volume is higher on days where the price move is in the dominant direction. For example, in a strong uptrend, there is more volume on up days than down days. Comparing relative action between price bars and OBV generates more actionable signals than the green or red volume histograms commonly found at the bottom of price charts. Number 9 on our list is the Average Directional Index, ADX, as a technical analysis indicator used by some traders to determine the strength of a trend. The trend can be either up or down, and this is shown by two accompanying indicators, the Negative Directional Indicator, D, and the Positive Directional Indicator, plus D. The ADX is a combination of these two indicators and smooths the result with a smooth moving average. To calculate plus D and DI, one needs price data consisting of high, low, and closing prices each period, typically each day. One first calculates the directional movement, plus DM and DM. After selecting the number of periods, Wilder used 14 days originally, plus D and D are calculated. The smoothed moving average is calculated over the number of periods selected, and the average true range is a smoothed average of the true ranges. The ADX does not indicate trend direction or momentum, only trend strength. It is a lagging indicator, meaning that a trend must have established itself before the ADX will generate a signal that a trend is underway. ADX will range between 0 and 100. Generally, ADX readings below 20 indicate trend weakness, and readings above 40 indicate trend strength. An extremely strong trend is indicated by readings above 50. Various market timing methods have been devised using ADX. One of these methods is discussed by Alexander Elder in his book Trading for a Living. One of the best buy signals is when ADX turns up when below both directional lines and plus D is above D. You would sell when ADX turns back down. Last on our list is the Commodity Channel Index, CCI, as a technical analysis indicator that measures the difference between the current price and the historical average price. When the CCI is above 0, it indicates that the price is above the historical average, and when it is below 0, it indicates that the price is below the historical average. The CCI is an unbounded oscillator, meaning it can go higher or lower indefinitely. For this reason, overbought and oversold levels are typically determined for each individual asset by looking at historical extreme CCI levels where the price reversed from. The CCI is calculated as the difference between the typical price of a commodity and its simple moving average, divided by the mean absolute deviation of the typical price. The index is usually scaled by an inverse factor of 0.015 to provide more readable numbers. The CCI fluctuates above and below 0, and normal oscillations will occur within the range of plus 100 and 100. Readings above plus 100 imply an overbought condition, while readings below 100 imply an oversold condition. As with most indicators, the CCI should be used in conjunction with other aspects of technical analysis. Traders and investors use the CCI to help identify price reversals, price extremes, and trend strength. It is often used for detecting divergences from price trends as an overbought, oversold indicator and to draw patterns on it and trade according to those patterns. The CCI typically oscillates above and below a zero line, and it is often used in conjunction with other oscillators to identify potential peaks and valleys in the asset's price. Market sentiment plays a vital role in crypto trading. Negative news and sentiment can have a profound impact on price movements. As we conclude our exploration of bearish crypto trading indicators, we hope you now have a deeper understanding of these powerful tools. Remember, successful trading requires a combination of knowledge, experience, and discipline. Stay vigilant, keep learning, and use these indicators wisely to navigate the ever-evolving world of cryptocurrency trading. I hope you enjoyed it and learned something new. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. Also, let me know in the comments below what are some other topics that you want me to cover, or what are some of the questions that you have about bearish trading indicators. In our next video, we'll continue to unravel the mysteries of the crypto market, uncovering more valuable insights to empower you on your trading journey. Thank you for watching, and I'll see you in the next video.